Indicators are used in global markets as a way to highlight opportunities for traders on their charts. Indicators have been favored by traders due to the ease of use and the lack of human error associated with them. Although some people say that indicators are completely useless and they do more harm than good for the average trader. So, what is the case? Should you be using indicators in your trading? In this video, we're going to look under the curtain of the world of indicators, so let's get right into it. Alright, what are indicators? They are visual aids placed on the charts to display some sort of information to the trader. It gives you a little bit of an insight into what market is doing, and it tells you about a specific variable of that market. This in theory is great for new traders who don't yet have a developed eye that is able to recognize the patterns in the candlesticks and be able to do fundamental and price action analysis. There are thousands of indicators you can overlay on your chart. Some are useful in certain situations, while others can be utterly useless. However, we recommend you would hold indicators to the same value as you do technical analysis. In order for technical analysis to work properly, there has to be a certain level of risk management and understanding of the fundamentals to be able to make it work. The same is the matter with indicators. There has to be more to your trading setup than just an indicator. If indicators worked in this manner, everybody would have already been a millionaire from trading, wouldn't they? Many of our traders use indicators to help them build a trading plan or the trading setup to get into the specific trade, but it's never the whole thing. There is a fundamental analysis, there's some technical analysis, and the indicator is just one of the other pieces of information, pieces of the puzzle that come together to open a trade. Indicators should be only used with other technical confluences. Something important you have to realize is that the price of a given asset will never move because there's an indicator placed on your screen. That's not why prices move. There are fundamental reasons behind why the price action happens. So that means that there has to be more to your trade than just an indicator overlaid on your chart. Let's take this example on the US dollar CAD. At first glance, traders would say the price fell due to the Fibonacci rejection of the 0.5 level. However, this isn't the case. By moving to the daily chart, we can see that the Fibonacci indicator was only part of the story. There was in fact a large bearish trend on the daily, a trend line break and retest, an EMA crossover, an EMA retest, and a structural lower low. So there was certainly more at play than just the Fibonacci indicator to give us a trade idea. If we are working off the assumption that the indicators are useful in certain situations for certain traders, there are some indicators that I wouldn't mind recommending if you properly backtest them and implement them into your strategy. Like I said, it's important that before you go live with any strategy, any indicator, you backtest it properly. We've made a few videos about that already. So here are some of the indicators that I actually find useful. The first one is a moving average. Moving averages, or exponential moving averages, are great tools for traders to gauge the market direction and potential pullbacks. During a trend, the market will frequently pull back to the moving averages, providing a range of trading opportunities. The larger the EMA or MA, the more data the indicator is working with. The second indicator I find really useful is the Fibonacci. The Fibonacci is a great tool for measuring the size of potential pullbacks during a trending market. This can help you frame your risk management within trades and potentially even allow you to estimate where trends may continue on to based on the size of the pullback. You'll notice that both of the indicators I've mentioned work best in a trending market. This is something you'll see across the board. Indicators as a whole tend to be quite unreliable in a consolidating or a ranging market. Alright, we've acknowledged that some indicators have their place in trading. However, most indicators you're going to be able to find on the internet today are not worth using. There are a couple of reasons for that. Let's look at 3 types of indicators that you should not be using on your trading charts. The first category is repaint indicators. Some indicators will repaint their analysis as the price moves. This makes the indicators look extremely useful when looking at past data, as they're accurately predicting every swing high and swing low in the markets. However, they're actually useless when used in real time. The second category I would stay away is indicators that are unnecessarily complicated. Indicators that have proved their value over the years, such as moving averages or Fibonacci, are very simple mathematic tools. They are based on simple math that the trader could work out on their own if they wanted to. But now, There is a wave of complex indicators in the market using obstructed logic, a math that we don't know where is it coming from, what is it doing, and it's keeping the logic hidden from the traders. These indicators should be avoided at all costs, as you cannot trade based on an indicator and math that you don't understand and you don't know what it's representing. And the third category that I would say are not worth it most of the time are paid indicators. Many companies now sell indicators that look really great in their demos, but in majority of the cases, these indicators are often just rehashed versions of indicators that are already free, that are simple, that are available. Or on the other hand, they are repaint indicators, meaning that they cannot be used in real time. You should definitely not waste your money on paying for indicators from failing traders who are trying to make a quick buck by selling you a rehashed or redesigned version of an already available indicator. Don't fall for that. Many of our own traders just like to trade using the naked charts or maybe a simple indicator or two. I don't think much more than that is actually necessary. Alright, and now we have to talk about the primary flaw of indicators. Their biggest flaw is that they don't have any real bearing on the market. As I've said before, it's economic news and fundamental reasons that drive the market action, that drive the price action, that are the reasons why the price moves where it moves. It's not the indicators. Traders often become too fixated on finding the perfect combination of indicators that will make them rich, that'll make trading easy, and that'll work 100% of the time. All because a bunch of lines on the chart line up doesn't mean that the price is gonna go where it says it's gonna go. This is what happens to a lot of traders, and they fail to make any profits in the market because of this. If you speak to professional traders, you'll find out that a lot of them will tell you that you won't find success in trading looking purely at charts. The charts are the easy part. The risk management and fundamental analysis are what it becomes really hard and really profitable. To wrap this up, indicators are not completely useless. They surely have their place in the trading world. You just have to accept a single fact. The market doesn't care about your indicators, and the price doesn't move because of your indicators. Thank you for watching this video. I hope you learned something today. If you want to get in touch with us, feel free to message our 24/5 live chat or leave a comment down below the video and I'll get back to you as soon as I can. My name is Ben Oliver. Thank you for watching and have a great one.